How's it going, everyone? This is Mike with InvestTheory.com. Welcome to episode 5 of our option spread series, where we're going to be taking an in-depth look at the bear-put spread. Now, before we dive into specific examples of how to use the bear-put spread, let's quickly refresh on what this vertical spread is and why we would want to use it. Now, as we learned in episode 1, the bear-put spread is a bearish position. It requires the trader to purchase a put option with a higher strike price, at the same time selling another put option with a lower strike price. Both puts need to have the same expiration date. Now, the reason we would want to trade this bear put spread is because we believe the underlying asset or the stock is going to have a strong decrease in price in the short term near future. So using this strategy allows you to take on a short position with limited risk and less upfront capital. Here's a diagram that shows what the bear put spread looks like in action, but let's take a look at an example right now. Stock XYZ is currently trading at $40 a share. Now, we believe that XYZ is going to decrease in the near future. So we can either purchase a long put or we can open a bear put spread and define our risk. First, we buy one contract at $42 strike price for $2.40. Secondly, we sell a contract with $40 strike price for $1. Now, our net cost of this trade is the buy minus the sell. And in this case, our net cost is $1.40 or $140 per contract. Now, remember, our goal is to capture the negative momentum or sideways trading in the stock while risking less upfront cash. Now, if the price of XYZ closes at $40 or lower, we will have reached our max profit area. Our max profit is the difference between the buy and the sell strike price minus the cost of the spread. So our max profit for this example is going to be 60 cents or $60 per contract. So if the price of XYZ increases beyond our long put of $42, we will have reached our max loss area. Now, our max loss is equal to the cost of the spread. So in this example, our max loss is going to be $1.40 or $140 per contract. So for this example, we are risking $140 in hopes to make the maximum profit of $60. So it's also important to determine our break-even price as well. Now, the break-even is equal to our strike price of the buy minus our net cost. So the break-even price for this trade is $40.60. Now, here's what this example looks like on the bear put spread diagram. Now, let's take a look at a real life example. Here is Disney October 26, 2018 put prices along with the strike price. So the current price of Disney is $117.17. Now, we are going to buy the $119 strike price for $3.08, and we're going to sell the $115 strike price for $1.15. So our net cost is the buy of $3.08 minus the sell of $1.15. So that makes our net cost $1.93, which is also our max loss for this trade. So now our max profit is going to be the buy strike of $119 minus the sell strike of $115 minus the net cost of $1.93. So our max profit is $2.07 or $207 per contract. So for this trade, we're actually risking $193 to make up to $207. Now that's pretty good. Now our break-even price for this trade is the buy strike of $119 minus the net cost of $1.93. Our break-even is $117.07. So here's what this example looks like visually. Now, let's quickly recap what the bear put spread is. So first, the net cost is the buy minus the sell. The max profit is the buy strike minus the sell strike minus the net cost. Our max loss for this trade is the net cost. And our break even is the buy strike minus the net cost. Now remember, the bear put spread is it's a good strategy when you believe that the stock will see a decrease in price or it's going to trade sideways. It has a defined risk as well as a defined profit. All right, everybody, tune in to episode 6 for the conclusion to our vertical spread series. If you're looking for a knowledgeable and fun community of traders to hang out and share ideas with, look no further. Invest Theory has brought over 3,000 traders just like you together in one free Discord chat. Join by clicking the link in the summary today and see how we can help you become an even better trader. This is Mike with InvestTheory.com signing out.